Corporate Finance Excel Practice Problem. In this presentation, we're going to work a practice problem in Excel related to cash break-even point. In other words, modifying the break-even point formula for a cash break-even point. Get ready. It's time to take your chance with Corporate Finance. Here we are in Excel. We have our information on the left-hand side. We're going to put that into the blue area into our worksheet on the right-hand side. We're going to have 3 tabs that we will be working with. You may have 6 tabs if you have the Excel worksheet, 3 with the answers on them, 3 with a pre-formatted worksheet such as these. They will be much the same, that we're going to be calculating similar formulas, just practice them a few different times. We're going to be modifying the break-even point analysis to now be considering the cash break-even point. So it's just a modification of our standard break-even point formula. So we'll be calculating the cash break-even point. So we're going to be taking a look at the cash fixed costs now, as opposed to the total fixed costs, one of our major differences here. So we're going to say, all right, let's do this calculation. We're going to say the fixed costs total would include the $730,000. Now, oftentimes we think of those fixed costs, those things that will not change, as the increase in revenue or decrease in revenue as revenue fluctuates, in other words. And we think of things, we've often mentioned the rent. The rent doesn't change. So if you have to pay the rent, then the rent's going to be what the rent is. But other things in fixed costs are often things like depreciation. And depreciation is something that's going to be an allocation of an expense, a cost that basically happened in the past, or cash outflow or purchase that happened in the past for property, plant, and equipment that we're now allocating to future periods. No cash outflow, though, is related to depreciation in the current period. So we might want to then look at our fixed costs without considering non-cash items such as the depreciation expense. So we'll take out the depreciation expense, and we're going to say that that's 15% of the fixed costs. So we'll say, all right, let's take these fixed costs times 15%, and that's going to be the depreciation, which isn't cash related. So let's put our underline there, home tab, font group, and underline, and let's say that now we have the cash fixed costs, and that's going to then be equal to the 730 total fixed costs minus the depreciation, which is a non-cash item, giving us the cash fixed costs. Let's break this out, and we're going to select these 3 cells, home tab, alignment, increase the indenting, then we'll increase the indenting here, home tab, alignment, increase the indenting. Then we'll pick up the contribution margin per unit, which is provided to us. The contribution margin per unit, you'll recall, is going to be the sales price per unit minus the cost per unit, giving us the contribution margin per unit. So we're going to say that after variable costs, we're walking away with $6.1. So now we have to think about how many of those we need to spend how many of those we need to generate in order to cover the fixed costs that are cash related. So if I go to the home tab, numbers, increase the decimals, home tab, font, underline, that's going to give us the break-even point. So we'll have the break-even point in units, the cash break-even point, we should probably call it the cash break-even point in units, is going to be equal to the 620,000 divided by the 6.1, and that's going to be the 101,721. So you can see then, if you're thinking about the break-even point, if you have the depreciation in there, meaning if I subtract this item, if I just delete this right here, you're going to say we need more units now to be covering the fixed cost. But then you're saying, well, yeah, but we're not actually paying the depreciation. That's not a cash item. If the difference between the depreciation and the fixed cost is the rent, we got to actually pay the rent. We're not paying for the depreciation. So I want to know how much cash, of the fixed costs that we have. And so then if I add in the depreciation, we're going to say, all right, there's the cash amount. That means we have less units. So you can see why that might be a useful calculation. Let's go ahead and prove it down here with our net profit calculation or net income calculation. Now we're going to modify this just a bit. Notice we're using like our contribution margin income statement. So rather than having revenue minus cost of goods sold, we're going to have the revenue or sales minus the variable costs, gives us the contribution margin minus then the fixed costs. Now we could calculate the sales minus the variable costs to get to the contribution margin, or we can take the unit contribution margin times the number of units sold and jump right to that contribution margin, the total contribution margin. So in other words, if I take the contribution, I'm going to say contribution margin, colon, it's going to be the units sales, units sold, or unit sales, and that's going to the break-even number we came to up here. So that's going to be our break-even number. And then we're going to multiply that times the contribution margin per unit, which is up here, contribution margin per unit, which is going to be the 6.1. And remember, that's sales price per unit minus the variable costs per unit gives us the contribution margin per unit. Home tab numbers, we're going to increase the decimals. Let's put an underline there, home tab, font group, and underline. That's going to give us the contribution margin. So contribution margin is then going to be equal to the 101,721 times the 6.1. So that's going to give us the 620, 500. That's like saying revenue minus the variable costs gives us the contribution margin. Now we're going to subtract out, or we would typically subtract out then, the fixed costs. So the fixed costs would then be this 730,000, but that 730,000 includes the depreciation. So if I took out total fixed costs, we'd say this is going to be the fixed costs of the 730. We're going to say this equals the 730. I'm going to put underline, home tab, font group, underline. That's going to give us net profit or loss, in this case, of this is going to be this minus this, and that's going to give us a negative 1095. That net loss is equal to the depreciation. So the net, we'll put it down here, net loss is the depreciation expense, because the depreciation expense is a non-cash item, right? So that's basically saying, okay, if we plug this back in, what do we get to on an income statement level? We're going to get to a loss if we use the total fixed cost of the depreciation, because that's a non-cash item that we basically took out of our break-even formula. So it's going to be a loss based on that non-cash item because we calculated the break-even point on a cash break-even level. All right, let's just practice it again. We'll do it a couple more times, a little bit more quickly. We're going to say, okay, this is the cash break-even point. Now we're going to say the total fixed costs are $2,300,000. Percent of fixed costs, it's going to be depreciation is 12% contribution margin per unit. So we want the break-even point, cash break-even point. Normally the break-even point is going to be the fixed costs divided by the contribution margin per unit. But now we want the cash fixed costs. So I'm going to be picking up the cash fixed costs. This will be our first calculation here, which is going to be the fixed costs total. And then we're going to think about those items that are going to be non-cash. A large one will typically be depreciation. So that's the example we will be using. Depreciation is going to be a cost or an expense on the income statement, which is not cash related because we're allocating the cost of a purchase in the past to the current time period. So we're not actually paying cash for this expense on the income statement. So we're going to be taking then the $2,300,000 times 12%. That's the amount of the depreciation expense. Let's put an underline here, home tab, font group, and underline. That's going to give us then the cash fixed costs, which will be equal to the $2,300,000 minus the $276,000. And that's going to be the cash fixed costs. All right, let's format this. Selecting these three cells, home tab, alignment, increase, indenting. Selecting this cell, home tab, alignment, increase, indenting. Then we want the contribution margin per unit. So we're looking contribution margin per unit, which is given to us. That would be calculated if it wasn't given. It would be the sales per unit, what we're selling each unit for, minus the variable costs per unit. And we're going to say then that's going to give us the $68. So that's going to be the sales minus the variable costs. We want to see how many of those we need to sell in order to cover the fixed costs that are actually being paid in cash, not including the non-cash fixed costs. So I'm gonna underline this. Let's do an underline here. We're gonna say this will be equal to then the 2,024,000 divided by the 68, and that's gonna give us our cash break even point. Let's put the double underline here. Home tab, font group, double underline. So remember, if I just had the normal break even point, I just wouldn't be compensating or taking out the depreciation for the fixed costs in this example, and that would make the break-even point go up, meaning we would need to sell more units to cover the fixed costs, which include those fixed costs without cash. But then we're going to say, yeah, but I'm really concerned with the cash payments we need to be making. So let's take out the non-cash item, and that means we have a break-even point of only 29,765 units. That's like kind of our minimum basis that we'll need in order to cover what we need to pay in terms of the cash. All right, so then let's do the proof of this. We're going to say, all right, well then let's do our net income calculation. Contribution margin, units sold. Units sold, we're going to say are equal to our 29,765 at our break-even point. The contribution margin per unit, we're going to multiply times the contribution margin per unit. This is kind of the quick way to get there. Remember, contribution margin income statement would be sales minus not cost of goods sold, but rather the variable cost to get to the contribution margin. We can also get to the contribution margin by taking the contribution margin per unit, which is the sales price or the sales price per unit minus the variable costs per unit, giving us the contribution margin per unit, that being equal to the 68. So if we multiply the 68 times the number of units, that's going to give us our contribution margin, which would be equal to sales, total sales, minus the total variable costs. Let's go ahead and underline this. We'll go to the Home tab, Font Group, put an underline here. We're going to say this is going to be the contribution margin, contribution margin. Let's format this, selecting these three cells, go into the Home tab, Alignment, increase the indenting, and then select this item, Home tab, Alignment, increase the indenting there. Then we're going to be picking up the fixed costs. So I'm going to say fixed costs are going to be this item. This is all the fixed costs, including the depreciation. So if I pick up all fixed costs, that'll give us a net loss of, if I subtract these out, the 276, which of course is the depreciation. So the net loss is going to be equal to the amount of the depreciation. Let's go ahead and double underline this one. Just like we had over here. I'm going to format, this is the prior tab. I'm going to format this a little bit here too. So select these three. Home tab, Alignment, increase the indenting here. And then Home tab, Alignment, increase the indenting. I'm just going to copy the same description and put that here. So there we have it. So once again, we're going to have a loss but that loss is due to non-cash items. The loss is due to the depreciation, the non-cash item up top. So that's kind of our proof on the net income side of things. Let's do it one more time. We'll do it a little faster here. So we'll say our next item, different set of numbers, but same process, fixed costs, percentage of fixed costs for the depreciation, then the contribution margin at 17. So we're going to be picking up our fixed costs then first, our cash fixed costs, which are going to be the fixed costs total. So there's our total fixed costs. We're going to remove the non-cash items included, which are major examples, depreciation, which you would think would be often the largest non-cash item. And this is going to be the fixed cost times the percent that's depreciation. So we're going to pull that out, put in an underline here, Home tab, Font Group, underline. That's going to give us our cash fixed costs. And this is going to be equal to the 6 million minus the 1,080,000. And then we'll take our contribution margin per unit. And that's going to be the unit sales price minus the unit variable costs given to us here at the 17. So sales price minus cost, unit sales price minus unit cost gives us the contribution margin. That's going to give us then the cash break-even point, which is going to be the 4,920,000 divided by the 17 in this case. So we got to sell 289,412 units. So let's underline here. Let's put a double underline there. So again, the normal break-even point would simply be the total fixed cost, meaning take away the depreciation. That would give us, we'd have to sell 3 352,941 units. And then if I say, well, I want to know how much cash we need to pay in terms of fixed cost. The depreciation isn't cash. Let's pull that out of the equation. Now we only need to sell the 289,412. Still a lot. Looks better than before though. So then we're going to say, all right, let's prove this. We're going to say net profit, basically our net income calculation on a contribution margin basis, is going to be the units sold. Units sold is going to be what we're going to assume here, the 289,412 for our break-even, cash break-even point analysis. We're going to multiply that times the contribution margin. So we're going to multiply that times the contribution margin per unit. Let's just type it in there, contribution margin per unit. And that's going to be the 17. So remember what the contribution margin per unit is, unit sales price minus unit variable costs. Normally the profit calculation would be sales minus not cost of goods sold here because we're doing the contribution margin income statement, but variable costs, total sales minus total variable costs. But you can also calculate that by taking the contribution margin, unit sales price minus unit cost times the number of units that you're going to sell. That'll take us right to the contribution margin. So the contribution margin is going to be equal to the 289,412 units sold times the contribution margin per unit. So that takes us to the same point as if we were taking total sales minus total variable costs, gives us the total contribution margin. So then I'm going to underline here, Home tab font group underline, and then we're going to subtract out the fixed costs. Fixed costs, I'll take the total fixed costs now of the 6 million. And that's going to give us a net loss of the 4,920 minus the 6 million, 1,080,000. Underlining this, double underlining that. And that, of course, is going to be equal to the depreciation expense. So this number is equal to the depreciation. We would expect to have a loss because we calculated our break even based on the cash break even, removing the expenses basically that are non-cash, that being the depreciation in this case, and that's resulting in our loss, but we know the loss is equal to that non-cash item. So that's kind of our proof for this calculation. Let's go ahead and format this by taking these three cells, going to the Home tab, alignment, increase the indenting, taking this cell, Home tab, alignment, increase the indenting, and there we have it.